makers and market movers. This is The Pulse with Francine Lacqua.
Good morning, welcome. You're watching The Pulse. I'm Guy Johnson in London. Francine is off today. Let me tell you what's coming up on today's programme. Bund yields and the euro extend their declines after French and German PMIs both missed estimates. Eurozone data dropping right now. British retail sales, though, last month jumped at the strongest pace since January. We're spending. We're also going to have the PMI data out of the UK this hour. And Bugatti unveils its $4 million hybrid. It's got a top speed of 276 miles per hour. We are going to hear from the company's CEO, Mate Rimac, a little later on in the programme. Good morning, folks. Let's talk about what's going on. You've got a euro area stock market, a UK stock market that are showing signs of softness this morning. Switzerland's also down as well. Let's call it Europe. Europe down today, as you can see on the screen in front of you. The equity market's not where the action is, though, this morning, folks. Let me tell you. It is in the currency markets and it is in the bond markets. This, as Europe reacts, the market reacts to weaker data pretty much across the board. We're certainly seeing that in terms of France and Germany, where you have seen some significant weakness. We're going to worry about Wiz a little bit later on, but let me show you what is happening with euro dollar. It is down on the back of the data, and the eurozone data crossing right now. You've got the manufacturing number of 45.6. You've got the services number of 52.6, so that's still at least positive territory. The comp number out of Europe, therefore, flat at 50.8, but that's down from 52.2. The market was expecting 52.5, so we've got weakness in terms of the data that we are seeing. Let me just see if I can get you some commentary, if I can update the website that we get this data from this morning and see if there's a commentary surrounding what we've seen out of the Eurozone this morning. Because what we've seen basically out of France and Germany is a pretty poor performance in terms of the story on manufacturing. A little bit better of a story when it comes to what we're seeing on the data from the services side of the economy. But nevertheless, the picture broadly not particularly positive and not as positive as we seem to have been hoping for. The Eurozone economic recovery suffered a setback at the end of the second quarter of the year, according to the provisional PMI survey data. This according to S&P Global. New orders decreased for the first time in 4 months, feeding through to softer expansions in business activity and in employment. That is the data that you are seeing this morning out of the Eurozone. Remember, in 30 minutes, we're going to get the data out of the UK. Let's get some assessment on what is happening here. Bloomberg's chief European economist, Jamie Rush, joins us now to give us his take. What do you think, Jamie?
Well, it's cooling off, isn't it? It's disappointing. I think the context, though, more broadly, is that the Eurozone economy is clearly recovering to some extent. The PMIs, they're lower this month, but relative to, say, the end of last year, we're still significantly up. So as long as this kind of momentum is sustained, I don't see a big problem here. I don't think the economy is going to suddenly contract. Fundamentally, what's happening in the Eurozone is inflation is coming down, wage growth's still pretty strong, real incomes are growing, and that's giving consumers the ability to spend. So I think we are going to see an ongoing recovery, even though we've seen a bit of weakness in this last month's data.
Let's talk a little bit about what this means for the ECB. I just want to kind of reference as well some of the commentary we're getting from S&P in terms of the inflation story. The rate of input cost inflation eased for the second month running in June and was the slowest year to date. Input prices continued, though, to rise sharply, however, with the latest increase still slightly stronger than the pre-pandemic average. What does this data in totality, do you think, tell us about how the ECB is going to be reading the Eurozone economy right now, and whether or not we do get a second cut quickly from the central bank?
Right, they'll be looking at this, and they'll look at the prices side, they'll look at the demand side, and both of those are pointing towards another rate cut coming at some point in the near future. Probably not July, but September almost certainly now, I think. Prices, disinflation, it is happening. The Eurozone is seeing price pressure dissipate. There's a little bit of pockets of strength still in wages and in services, but even then, when you look at the more timely data, that is coming off at quite a pace. And the other thing to remember is that the ECB doesn't really want growth to be massively above trend at this juncture. It doesn't want the economy overheating. Yeah. We have 0.3 in 1Q. We don't want it much faster. I think they've got 0.4 for 2Q. So actually, this might be a relief to them.
Yeah. The commentary also is the pace of output inflation also eased in June and was at an 8-month low. So that maybe is consistent with what you're saying about this giving maybe some clarity to the ECB. Jamie, how much on the manufacturing side is down to what we're seeing out of China? Can you draw a line between the weakness we're seeing in manufacturing and the weakness we're broadly seeing in the Chinese economy? Is there a strong connection there?
I mean, I think it's certainly part of the story. There are a number of structural factors, aren't there? So you've got weakness in Chinese demand, which is kind of a cyclical element. You also have the fact that China is just moving up global value chains and now providing much stiffer competition with particularly German exports than it has done in the past. And at the same time, obviously, we've lost this abundance of cheap gas, so that's really challenging a lot of business models across Europe. So I think it's very unlikely we're going to return to anything like the sort of pre-pandemic, pre-war trend for industry in Europe. The question is how quickly can the economy reorientate and services pick up the slack? And we are now seeing that, at least now with consumers being able to spend. That will help.
In the commentary surrounding the French data, S&P made the point that they expected a boost from the Olympics. And I'm wondering whether the danger is there that gets superseded by the impact of the election. How should we think about what impact that election is likely to have, do you think?
Well, it's hard to see it at the moment in the PMI data, because we know that the survey was after the snap election was called, so it should be recorded in there. But what we don't see is a particularly different performance for France relative to, say, Germany. Germany fell as well. So I don't think we're seeing anything yet. But clearly, there's just been a huge amount of uncertainty injected into the policy outlook. The different candidates for leading France have completely different visions of what the future looks like. And there is obviously a huge fiscal risk here, because at least two of the three contenders want to spend quite a bit more money at a time when France is pretty indebted and interest rates are going up on their borrowing costs. So it's going to be a difficult moment over the coming few weeks, and then when we get more clarity on what those policies look like, we should hopefully get some resolve there.
Let's hope we do get clarity. Jamie, great stuff as ever. Thank you very much indeed. Chief European Economist here at Bloomberg, Jamie Rush. What are we going to talk about next? We're going to turn to a conversation that Francine has had with Lazard's chief executive. Peter Orszag is a person you definitely want to hear from. That conversation is coming up next. This is Bloomberg. Friday the 21st of June, 10 past the hour. This is The Pulse. I'm Guy Johnson. Francine is out today, but she's here in spirit because you want to listen to this next conversation. The Lazard CEO, Peter Orszag, telling Francine that the company is weighing several opportunities to acquire a private credit firm that would help expand its $250 billion asset management arm. Speaking exclusively to Francine, Orszag discussed the company's ambitions and the expansion plans he sees pushing through. Rate cuts were also a topic of discussion, plus also the impacts of the upcoming elections in France and the UK. Take a listen.
What's in the pipeline? When you look at M&A activity, is it looking a little bit better? Are we seeing green shoots?
We're definitely seeing momentum and activity, mostly still with companies, corporates, but I think the next stage is, especially once we see a Fed rate cut, you're seeing sponsors already entering the playing field. That will accelerate substantially upon a Fed rate cut, because then you'll have the combination of demand for return of capital from the LPs and also a rate environment that's more conducive to increased sponsor activity.
So you're expecting that Fed cut to be almost like a light switch, even if they don't continue cutting?
I don't think it matters how many cuts happen this year. I think what matters is that first rate cut is indeed a light switch, because what that signals is the Fed believes that it has won the war on inflation, and so it's all downhill from there in terms of rates.
We're seeing IPOs being pulled at the moment. M&A is subdued for a number of factors. I don't know whether there's a price mismatch or whether it's just, there's caution on the markets because of geopolitical uncertainty.
Well, I think what's been happening is there are big underlying tectonic plates that fundamentals that cause activity. So technology, the energy transition, de-risking from China, the life sciences biotech revolution. Amazing forces for deal activity, but there have been headwinds. So there has been a buyer-seller disconnect. There have been financing market issues, antitrust/regulatory, and now elections. The first three have largely faded. People have gotten used to a new work environment. So yes, elections are a source of uncertainty. Obviously here in the UK, in France, in the United States, this is something that is on the minds of people in boardrooms and C-suites.
The France snap elections certainly roiled the markets. Is that hurting activity there?
I think there's concern. Anything that's unexpected, businesses like stability, so there is concern. We'll have to see how it plays out. But I think writ large, don't forget, we're focused on 2 or 3 elections that get the disproportionate share of attention, but there are more than 50 elections across the globe in 2024. And it's now impossible to make a business decision without taking geopolitics into account. And this is just an illustration of that.
And frankly, the U.S. being the biggest one.
The U.S. is a significant one.
A significant one. Does that really change, I guess, investor appetite for deal making, depending on which way it goes?
I'm not sure. I mean, what's happening now is the U.S. election, typically like in a business meeting, there'll be the first 5 minutes, which is kind of the warm-up, and then the what you were actually there to meet about. And the U.S. election, at least in U.S. discussions, is still the first 5 minutes and not in the bulk of the meeting. That may evolve over time as we get closer to the election. But I think right now, there are those who believe that, it's not driving decisions yet, let me put it that way.
So you have pretty ambitious targets, financial targets for Lazard. Are you confident that you'll hit them?
Absolutely. So I think, look, Lazard has an amazing brand. We have remarkable people, and we have renewed ambition. So the combination is what's going to drive us forward.
So there's a bit of a restructuring, I guess, taking place right now. Would you call it that? And what's driving? Why now?
I wouldn't call it restructuring. I would just call it, again, renewed ambition.
Okay.
And why now? We had a leadership change, so I can just speak to what I'd like to do, which is really take this remarkable institution that's been around for 176 years, that is fantastic at providing excellent advice and counsel both to companies and to investors, and to incorporate the geopolitical piece, as I mentioned. And one thing that I think is often underappreciated is Lazard is the only independent advisory firm that is strong in both the US and Europe. And that combination, combined with the importance of geopolitics, is going to drive the franchise forward.
So where do you want to grow? And is it organic growth, or are you also looking at acquisitions?
It depends on which part of the, yes.
Both?
Yes. I think on the advisory side, it's going to be mostly organic growth. That's just hiring talented people. We've been adding lots of really qualified bankers, leadership in Germany. We have a new head of media, sports, and entertainment. We have a new president, Ray McGuire, and so on. So we've been adding a lot of really high quality talent. On the asset management side of the business, I think there is hiring to do, but there's also more opportunities for inorganic growth.
I mean, asset management feels like a crowded space. Is that fair? Do you feel like it's going to be a challenge? You also have rivals trying to poach some of your people, and in certain cases they've been quite successful.
Yeah, we've been successful. I mean, I think the battle for talent is a never-ending one. And I will say this: I have worked at lots of different organizations in my career. Lazard is a fantastic culture in which people are commercial out there trying to win, but they also treat one another with respect and are collegial, and that combination is really compelling.
But are you trying to almost make it more one team, right? So that there's more collaboration amongst your employees?
I think there's a remarkable amount of collaboration that already exists, but yes, what we can always do better and always do more, and that's the way to win in today's environment, because clients are looking for insight into lots of different sectors in lots of different markets, and no one person can be all of that by themselves.
But are you shopping around for a big ticket acquisition or something bolt on?
So the inorganic activity that we are likely going to do, which I've already mentioned publicly, is in the asset management space. We need to protect where we are. We need to expand by doing some additional hiring where it makes sense in public markets, and then we need to acquire. And the acquisitions will be disproportionately in private markets, so in private credit, infrastructure, real estate, places where we are not very present yet.
I mean, again, private credit is the thing where everybody wants to be on. Any concerns about valuations compared to private equity?
We're going to be very cautious as we go through this, both on the pricing. I mean, that's to make sure that it's in shareholders' interests to do some of these acquisitions, but also on culture, because you can get something at the right price, and if there's not a good cultural fit, it still doesn't work. So it's really an elaborate process that we need to go through. We have a new head of corporate development. I'm very excited. So we're in the mix, evaluating lots of options.
But do you worry that parts of private credit could be in a bubble?
Private credit has grown very rapidly. I think private credit will be here for the long term. Will there be some wobbles as some of the rapid growth plays itself out? Entirely possible, but for the asset class as a whole, I think it's going to persist.
So there are rumors, many rumors, that you were very close to selling Lazard. Any truth? Like, what do you see? Do you feel like you're a target? Have you been a target?
I think Lazard is best as an independent firm, and I think that's going to be our pathway forward.
So you'll not confirm or deny? It's like MI5. Were you part of a M&A deal, maybe?
Look, we're a public company. People always are interested in approaching us and having discussions. But I go back to Lazard. Its DNA is really founded on independent advice delivered to clients, and so that independence is really important. We're a public company, and we acknowledge that. But the independence is really core to who we are.
That was, of course, the Lazard CEO, Peter Orszag, speaking exclusively with Bloomberg's Francine Lacroix. Coming up, we are going to take a look at why Macron's snap election gamble is putting the rise of Paris as a financial hub at risk. That conversation next. This is Bloomberg. Welcome back. Friday the 21st of June. Let's turn our attention back towards what is happening in France. The far right and leftist political forces are very much vying to take power in France. Yesterday, though, they faced quite a hostile reception from entrepreneurs and business leaders. This as they laid out their competing visions that featured, to be honest, scant detail on how to fix public finances in the country. The parties which are leading in the polls ahead of the upcoming legislative elections appeared at hustings in Paris hosted by the country's business lobby, which of course is MEDEF. On the fringes of that, our colleague, Bloomberg's Caroline Conan, talked to a few of the key people that you want to hear from.
I think you're the one causing the concerns on the markets in a pointless manner. We have decided to widen our majority because I think there is a real danger today to see Jean-Luc Mélenchon and the far left coming to power, which would make France like Venezuela without the oil.
The
first panic on the markets was linked to the snap elections call. So go and ask Mr. Macron why he thought it was a good idea to worry the markets. I don't think our policies will worry them for very long because they will not bankrupt the country. France will remain a safe investment.
The right and the left. Who's going to come out on top? Will anybody come out on top? Jordan Bardella, the National Rally president, and Eric Coquerel, the former MP for France Unbowed, speaking to Bloomberg's Caroline Conan there. Let's talk a little bit about what is happening in the background to all of this. Over the last few years, Emmanuel Macron, the president, has positioned post-Brexit Paris as being the new finance hub of Europe. How closely associated is that rally that we see, that renaissance of France, Paris as a financial hub, as a key centre tied to him? Let's ask that question now to Alex Razbandari, Bloomberg's Alex Razbandari in Paris. Alex, if Macron has a setback, does Paris as a financial centre have a setback?
Well, as you said, most Wall Street lenders have increased operations and headcount in Paris over the past years. And, you know, even earlier this month, Macron promulgated a law that made firing traders cheaper in the country. So the decision blindsided everyone. Now, to be clear, none of the banks that move traders to Paris have announced their intention to scale back on those plans. And when you speak to people familiar with their thinking, it appears that, you know, their investment strategy in Paris was in a long-term view. and the current uncertainty is not going to affect that for now. However, when you speak to lobbyists in Germany, Italy, or even in the UK, people are starting to hope that their own country is going to be a little bit more competitive and attractive when firms are looking for a place to set foot in Europe.
Yep, everybody's rubbing their hands elsewhere. Alexandra, thank you very much indeed. Alexandra Rajbandari joining us on the potential reversal of that trade. Coming up next, we're going to take a deeper look at the potential impact of today's UK data on next month's election. We're about to see PMI data drop out of the UK. We've already seen consumer confidence and retail sales. We'll address all of this next. This is Bloomberg. So, welcome back. We're waiting for the UK PMI data to drop. While we do that, let me just kind of recap what is happening with the markets. The euro on the back foot this morning, 106.82. The reason for that, very weak French PMI data and mixed German data, but the manufacturing side of the German data remains very weak. The S&P commentary around that talking about it hitting a wall. So we're now waiting to see exactly what happens with the UK data. Remember, we've had retail sales that have been fairly strong already this morning. You've seen overnight the GfK data that has also been fairly positive as well. The British data generally of late has looked more positive, and potentially with some political stability, that may be a story that does continue. So we'll continue to watch and see what the data delivers. The UK numbers are the ones that are about to drop next. And we'll try and get some commentary around what is happening here. Dan Hansen will be joining me in just a second. So here we go. 51.4 is the headline number. That's up from 51.2. That's the manufacturing data out of the UK. The services number of 51.2 is actually a little softer. Interesting. We'll see whether that changes as we go through the summer, but certainly some significant weakening in terms of the services side. The comp number therefore comes through at 51.7, which is down from 53. So actually, in some ways, again, some weaker data than maybe we would have originally anticipated. The pound is just beginning to soften up a little bit on this. Let me see if I can get you some commentary off the website and give you some analysis as to what is happening here. I may need to put my glasses on just to read what is going on. In terms of, this is the commentary from Chris Williamson down in Exeter. Flash PMI survey data for June signals a slowing pace of economic growth, indicating that GDP is now growing at a sluggish quarterly rate of just over 0.1%. So the feel-good factor may be starting to elude the UK in the way that it's eluding those on the continent as well. Remember, we're 2 weeks away from the general election. Dan Hansen joins me now to give us some commentary on this from his point of view. What do you make of that?
It's pretty weak, isn't it?
Yeah, feels like
we were expecting about a 53 number. Like, that was our expectation. So basically unchanged from where we were last month.
Services.
Yeah, and that is surprising. I mean, one thing, I'm just trying to get the press release up here myself, but one thing that's going to be really important for the Bank of England is what's going on output prices, whether we've got an easing of inflationary pressure there, because that's something they've been looking at.
Yep.
It's obviously a leading indicator, particularly they're so obsessed with services inflation at the moment. It's really key that eases as well. But just on a headline level, you're absolutely right, Guy. This is weaker than expected. And I think it plays to the story that the first quarter was a bit of an anomaly, if you like, that really strong first quarter GDP number. I think we're going to get a slowing through the rest of the year. And it might be in part due to the fact that there was so much exuberance at the start of the year about rate cuts. And now people have sort of had a bit of a reality check about how far interest rates are actually going to come down. Is
this temporary? So it's interesting. Chris Williamson talks about the slowdown in part reflects uncertainty around the business environment in the lead up to the general election, with many firms seeing a hiatus in decision-making pending clarity on various parties. So is this a temporary blip, do you think?
It's interesting, isn't it? Because it just feels so certain about what the outcome of the election is going to be.
That's the weird thing.
That's strange.
But what we don't have is certainty on the policies.
No,
maybe that's where the...
I think that, yeah, and it's possible, you know, Labour, for example, we've been thinking through the idea of where Labour come in and they're a little bit... they're a little bit bolder, if you like. They've got a very modest manifesto. We know that. Very small spending and tax numbers. But perhaps they come in and they're a little bit bolder. So it's... And obviously these manifestos, they don't have huge amounts of detail in. So I think it could be, as you say, there could be a bit of temporary nature to this. But it's interesting because it does feel like of all the elections we've had, at least recently, the outcome of this one is much more certain.
Yeah, in short, while a slowdown in economic activity, in economic growth may prove temporary, should businesses react positively to the policies announced by a new government, the stubbornness of the underlying inflationary pressures above the Bank of England's target still looks somewhat ingrained. Which is so. Let's turn to that last bit. Inflation being ingrained in terms of what you see in terms of the prices. On inflation, prices charged inflation across the private sector consequently rose to a 4-month high in June. Does that put your August rate cut in doubt in any way, do you think?
Let's see the CPI data.
OK.
I think reading the minutes yesterday, and we spoke about this earlier, that they feel it looks to me like they're really keen to cut.
Yeah, it does feel like it.
You know, they essentially dismiss some pretty big upside surprises in the services CPI data. At least a majority of them seem to be close to dismissing it. I think if we get the services CPI data, it's July the 17th, I think. If that's broadly sort of tracking down, continuing to track down, I think we're on. I think the broader story, though, and it kind of goes against what we're seeing here in the PMI, is that the economy is doing better than almost everyone thought at the start of the year. The recovery has been stronger. I think the underlying inflationary pressure is probably the momentum there is probably a little bit stronger than people expected. And that means, yeah, OK, you do August, but after that, you've got to be pretty cautious about how quickly you let your foot off the brake.
Great stuff, Dan. Thanks for the instant analysis on what we're seeing in terms of the data that we're getting here. Chief UK economist Dan Hansen from Bloomberg Economics. Look, we've got 2 weeks to go until the general election. The next government's got a lot to manage. The continuing fallout from Brexit, the pandemic, Russia's war on Ukraine, and the debt burden, all kind of exacerbated by these three factors. The key challenge, though, for the UK economy remains productivity. If you want to lift the perimeter of this economy, if you want to make this economy bigger so you can actually charge a lower tax rate but gain more revenue, you need to improve that. And that's what is at the core of our mini-doc today, which is on the UK economy. Take a listen to what is happening here.
Britain's economy is under incredible strain, more than you may realise.
Austerity through to successive, extraordinarily expensive and damaging crises has left the UK with an enormous debt burden.
Compared to our friends here, or in fact in any major advanced economy, national debt in the UK has ballooned the most since COVID. But it's not just borrowing that's an issue. Look at tax revenue as a percentage of GDP, basically the share of the country's output that the government takes to pay for what the public needs. And in an election year, that's a massive problem for whoever's tasked with writing a new spending plan.
There's 1 million people, in a sense, missing from the labour force, many of them claiming disability benefit or sitting on NHS waiting lists. That represents a lot of missing productive capacity.
This is all monumental pressure for the next government to withstand and relieve. They need to get the population able to work, doing so, and in a more productive capacity. Then there's wiggle room to deal with high interest rates and bring down national debt, freeing up tax revenue to bolster public services and support the people unable to work in the first place. Everyone agrees this is an enormous challenge, but if it's one a new government can pull off, the potential gains are massive.
A Bloomberg Originals report on the economic challenges facing the next UK government. How do you lift productivity? So that will be part of the debate that we're going to have on Monday here at Bloomberg. So on Monday, the UK Business Secretary, Kevin Badenoch, and the Shadow Business Secretary, Jonathan Reynolds, are going to be going head-to-head. It's a live televised debate. It's moderated by Francine Lacroix. They're also going to face questions from Britain's leading business groups. Viewers can catch that business debate. It's 12:30 p.m. UK time, Monday on Bloomberg TV. It's going to be on the terminal. It's going to be on the website. It's going to be on YouTube. It's going to be on Bloomberg. It's going to be everywhere with the Bloomberg attached, basically. Let's talk more about what is happening here. 91 says the UK election could serve as an opportunity to boost investment in Britain's infrastructure. Joining me now is Nazmeera Moola, Chief Sustainability Officer at 91. Thank you very much indeed for joining us.
Thanks for having me.
Look, that package kind of encapsulates some of the stories, I think, really beautifully that the UK faces right now. It has a productivity problem, which is caused by a number of different things, one of which is the labour market, but the other one is what is happening with fixed investment. Mm-hmm. And that has been an area that the UK has been lagging in, particularly versus the United States. When you think about your sustainability story, when you think about what the UK economy is going to do next, do those kind of Venn diagrams overlap with a need for a significant pickup in that infrastructure investment?
Definitely. So as we think about, I'm an economist originally, so my geeky background is as an economist.
We're okay with that.
And as a result, when we think about what drives economies over the medium term, capital investment by both the public sector and infrastructure and the private sector in their own corporate capacity are critical in the medium term. And what we've seen over the UK over the last 10 years is both of those things have been cut as parts of general austerity. So this increase in debt has gone into consumption and not into productive capacity.
Is that the difference between Europe and the United States right now? Because we often talk about the kind of big deficits that exist in the United States and the sustainability of the debt story in the States. But the Inflation Reduction Act, while it has increased the amount of spending, a lot of that spending has gone into productive capacity, i.e. the economy has a higher potential as a result of that. Have we missed the trick here in Europe?
I think that the Inflation Reduction Act's full spending potential we haven't even seen yet. It's still going to come.
Yep.
But a lot of what we have seen is entirely productive capacity. But more importantly, you've seen corporate America invest in productive capacity. American corporates have felt comfortable and confident enough to invest in their own backyard.
Let's talk more about Europe then and what we're going to do next, because it feels like rather than kind of mimicking what we're seeing over in the United States, we've got a political story that is going to sow confusion and lead to corporates making the exact opposite decision that we're seeing over in the United States. How do you think that the political turbulence we're seeing, France is the obvious example, is going to ultimately affect Europe's ability to make the energy transition, to invest in the productive capacity that we need, to invest in the generating capacity that we need? Politics, stability and investment tend to go hand in hand.
Definitely, because what happens in corporate boardrooms is you have a whole lot of non-executive directors who are inherently risk-averse.
Yeah.
So now you have a situation where they look at the political environment and they go, do we want to actually borrow a whole lot of money, put it into the ground, and we don't know if we're going to generate a return for it? And that Europe's advantage over the last couple of years is they've had a very clear agenda in terms of the energy transition. What worries me with all these elections coming along is that that starts to become much more uncertain.
In terms of what was the message from the European elections? My take was that the electorate is deprioritising, though, the energy transition, deprioritising the green transition. Is that the right read?
I think the electorate is worried about rising cost of living and their ability to actually afford things. They're worried about immigration to some extent. You saw that in the German election come out in a very meaningful way, where a lot of the former East German space became much more right-wing. And so I think when we think about energy transition, we need to think about it in this triangle of transition, affordability, and energy security.
Okay, so let's think about that triangle. Where are we struggling to kind of make the turns?
Certainly affordability.
Yeah.
Because we've been pushing transition so hard that as energy security became an issue, prices went up.
Yeah. And that started with the Gilets jaunes, and that's been writ large through European politics for quite some time. That's not new. So why is it taking us so long to figure the answer to that question out?
Because I think from the failing on the sustainability side is we focus too much on the supply of fossil fuels and not enough on the demand for them.
Right. Okay. So solve that problem for me.
Well, I think if we were dealing with a sensible policy environment,
yeah,
which we're not, we've already established that's not the case, but if we were dealing with a sensible policy environment, what I would be saying is let's spend the next 5 years reducing the demand for fossil fuels by accelerating the transition to electric vehicles, alternate sources of heating.
Yep.
Let's focus on that side rather than saying, actually, we need to pump less oil off the ground.
Okay. On that note, that interesting note, we will leave it. Nazmeera Moola, Chief Sustainability Officer at the Anglo-South African asset management firm 91. Thank you very much indeed. This next story kind of gets halfway to maybe what we're discussing here. Bugatti unveiling a $4 million, 1,800 horsepower hybrid hypercar. It's a hybrid. It's called the Tourbillon, and we're going to hear from the company's CEO next. This is Bloomberg. Welcome back. You are watching The Pulse. I'm Guy Johnson in London. Let's talk cars. The luxury car maker Bugatti has unveiled the Tourbillon. It's a $4 million, 1,800 horsepower hybrid hypercar. It will succeed, of course, the Chiron as the company pushes to extend its hypercar dominance and secure a stronger position within parent company Volkswagen. Bugatti Rimac CEO, mate, Rimac spoke to Bloomberg's Ollie Crook.
In the vast range of really, really expensive supercars, very few come as close in price to a Bugatti. They've lived up to their reputation with their newest model, the Tourbillon. Replacing the Chiron, it was redesigned from the ground up, and it had to be. It's their first ever hybrid model. With an 8.3-liter naturally aspirated V16 engine, plus 3 electric motors, it packs a whopping 1,800 horsepower, propelling it more than 400 kilometers or 250 miles per hour. And it can be yours for a starting price of 3.8 million euros. I'm very pleased to be joined by Matej Rimac, who is the CEO of Bugatti Rimac and joins us now from Zagreb. Thanks so much. Really great to speak to you. Very exciting car that we now have off. I think it's really interesting for Bugatti because every time you guys release a car, it's not a car for a couple of years. It's a car for something closer to a decade. You have now decided to release your first ever hybrid. You have an electric car background. Why did you stick to the ICE?
Well, actually, as you say, each new Bugatti is a big occasion. But a completely new one, developed completely from scratch, which the Tourbillon is something that comes around only every few decades. Let's say shareholders were pushing that the next Bugatti should be electric. And at that time, that might have been sounded like the right decision.
And you mentioned your your customer, who is obviously a very unique customer, a very rich customer, but a very sort of savvy customer. So why for them is the starting price 3.8 million euros? Why is this car worth that?
Well, it's Bugatti, first of all. That's something very special. But you can see by looking at the car and by feeling the car, it's very unique at every detail. For example, one of the things we wanted to achieve that every piece of the car is actually a piece of art for itself. So you can pick any piece up, put it on in a gallery, and it would be an exhibition piece, even without the rest of the car. If comparable, it's no longer Bugatti. So it's something completely unique and something completely different than anyone else. And also what I said, nothing is too beautiful, nothing is too expensive.
I want to understand where you're selling most of your Bugattis right now, and where do you see geographically the most promise?
1/3 of the market is US, 1/3 is Europe, and 1/3 is the rest of the world, mostly Middle East and a little bit Japan and some other markets. We currently do not sell at all in China, but the market of ultra high net worth individuals is growing constantly, and I think it's predicted, or it's pretty clear that the market will continue to grow.
How is the Bugatti customer, the kinds of people buying the car, changing? Is there a sort of a shift in the age? Are they becoming younger? Are more women buying? What are you seeing there?
Yeah, we definitely see a shift, especially, let's say, young tech entrepreneurs, be it through from the finance space or online gaming or some kind of, let's say, new businesses that are more in the energy sector or tech in general or real estate. We see that changing a lot now. So a younger audience being interested in the brand. And I mean, Bugatti stands for you made it. It's the ultimate you made it symbol.
You must crash test these cars. How painful a process is that?
Yeah, well, there is no shortcuts in producing very expensive or very low volume cars. Actually, we, even from our perspective, regardless of the regulation, we want to make sure that these valued customers are very safe. So we do thousands of tests and hundreds of homologation tests and crash tests. So we have to build something around 30 prototypes in the development process, and around 15 of them will be crashed multiple times over and over again until we pass all the crash testing.
You got to really hope you don't crash one of those. Ollie Crook speaking to Matej Rimac, the CEO of Bugatti Rimac. We're going to carry on the conversation when it comes to supercars a little bit later on, right here on Bloomberg. Katie Greifeld's going to be sitting down with Ferrari's CEO. You definitely don't want to miss that conversation. They're in the race as well. It comes up 3:15 London time. That's 4:15 CET. What are we going to do next? We're going to take a look at what is happening with these markets. The Nasdaq has been, well, the Bugatti recently, certainly racing ahead. We'll talk about whether or not that comes to a crashing close soon with Van Ram. That's next. This is Bloomberg. Big story this morning. Weak PMI data out of Eurozone countries, including France and Germany. Is the market reacting correctly to the data we're seeing? Let's ask that question to Market Live's Van Ram, joining us now from Dubai. Van, what do you make of the data? What do you make of the reaction?
The data is undoubtedly weak, Guy. I mean, across the board, France, Germany, Eurozone, wherever you look, the data is pretty weak. I think the only kind of silver lining, if there were one, is that the services PMI is much more resilient than the manufacturing PMI, and that's the reading that really matters for the ECB for inflationary reasons. Now, one crucial aspect to keep in mind was that the data for this edition of PMIs was compiled between June 12th to 19th. That, of course, coincides with the period when the tumult regarding the France debt issues and the political risk was at its peak, relative peak over the short term. So, you know, the ECB is going to look at the data and say, okay, was this unduly influenced by what was happening in France that week? So I think that they are going to want to wait for more data down the line to see if this is a trend or is it a one-off thing. And in any case, the ECB has kind of revised up its growth forecast at its June meeting. So they've got a fair bit of wiggle room in terms of the growth outlook before they start thinking, okay, this is an economy that needs immediate accommodation.
Okay. Van, the first thing I read this morning was your piece on why you think the Nasdaq is heading for a fall. Just give me the 30-second précis on why that is.
Well, if you estimate, if you assume that the Nasdaq is a long-term bond, estimate the cash flows that will accrue from holding that bond every year and bootstrap its valuation using a reasonable discount rate, what you find that is that Nasdaq 100 is the fair value is just a whisker short of 13,100. So despite yesterday's decline, the index is still overvalued by an astounding 50%. Essentially, it's like a bond that is trading at 150 cents on the dollar. And that is why investors should be careful.
Ben, have a great weekend. Thank you very much indeed for joining us. Bloomberg's Van Ram. Have a great weekend, folks. Enjoy the weather. The brief is up next. Manus Cranny in New York. Over to you. This is Bloomberg.